Welcome back, traders and investors, to our final segment of Fed Forecast 2015. I'm your co-host, Joel Alconin. I'm joined by Garrett Cook, and we have some other distinguished guests on the line. We have Richard Vague. He's managing partner at Gabriel Investments. And we have Dr. King Banaian, former Minnesota state representative. How are you guys doing today?
Well, how are you?
Doing good, doing good. So, I want to start out with you, Richard, and I don't know if you just heard that lively exchange that we had, regarding the Fed, but you kind of take the position that the Fed really doesn't have that much effect on the economy. Could you go into detail on that?
Well, of course, the Fed does have effect on the economy. It's just it has a secondary effect compared to private debt. If you look at the U.S. right now, we have about $25 trillion in private debt. Public debt outstanding is about $17 trillion. So the biggest factor generally in terms of how the economy is going to perform, what it's going to do, whether we're going to have a crisis or not, is what happens to private debt. And the Fed's impact on that is secondary. And, most of that is not as affected, as you have certain investment firms that have highly leveraged positions in government bonds. They care a great deal about what the Fed does. The small business and man on the street is much less impacted.
Okay, let's go to you, Dr. Banaian, and you were in the legislature, and what's their view of the Fed?
Well, largely among the Democrats in the legislature, they didn't think too much about it. But among some of our Republican colleagues, they were quite concerned about the amount of debt and the possibility of having a collapse that might influence their own ability to issue debt. We can talk about federal debt quite a bit, but there's some state debt out there, much of it for infrastructure purposes. Minnesota, where I live, is a much easier place in terms of its debt load. But you go to places like California or Illinois, where there's a lot of debt that's tied up in infrastructure projects and borrowing for public pensions and so on. And what the Fed does in terms of keeping interest rates lower to make the cost of that borrowing easier and allow those legislatures to muddle through with some very weak fiscal structures is very important to them.
So let me follow up. Sorry about that, guys, with the sound there. Could there be some sort of unknown event that could potentially trigger the next financial crisis? It seems like we're always kind of responding to the last known event. So do you guys see the potential next problem being a further unknown as opposed to potentially what we're all looking at, such as debt or Fed action?
If you look at, this is Richard, if you look at all major financial crises over the last century, they have all been a function of a very rapid run-up in private debt. And frankly, in periods before a crisis, government debt has been pretty well behaved. It's a typical characteristic of the immediate pre-crisis period. So we're not going to have a crisis come from an unknown source. We haven't in the past. We're not in the future. The areas where we have concern about crisis today, the first and foremost is China, where we've had a 60% run-up in private debt to GDP, the equivalent of 12 trillion U.S. dollars over the last 5 years. And you have ghost cities and, overcapacity in petroleum and copper and aluminum, steel and iron, all as a consequence of that. So that's the biggest area of concern in the world. And because what China has done is now putting downward pressure on prices, including oil, you're going to have some ancillary crises in Asia, but you're already starting to see that in other commodity-dependent countries, most notably in the last couple of days, Russia, where the downward price in oil has meant that the government there had to step in and rescue the third largest bank in that country.
So is this evidence then that the public sector either doesn't understand debt management or how to utilize debt as part of a financial tool set within an entire process, given that, public debt seems to kind of be the trigger point? There's a run-up in it, there's a mismanagement of it, and then we seem to have underlying
You
problems.
mean private debt?
Private, yes. I'm sorry, I didn't mean
debt.
public.
Yeah.
I apologize. Private debt, yes.
Yeah, I think there's a the evidence would suggest that the private sector, when debt is growing rapidly, private debt is growing rapidly, it tends to be a period of euphoria. Everybody's winning. Things are great. Buildings are getting built. Everybody's winning. Tax revenues at the government level are increased. So yeah, it is, and I don't think the regulatory apparatus is really sufficiently aware of this to want to or be able to step in and moderate growth of private credit when it ought to be moderated. And hopefully that's something our research is going to help bring an awareness of.
So
I would look at.
Go ahead, Dr. King, please.
Thank you. I would look at the growth of the money supply generally right now. Real M2 is growing about 5%. Commercial industrial loans growing a little bit faster than that. At least in the United States, you're not seeing it so much. So I think Richard's right that if you're going to look for where the causation comes from for the next crisis, I think it comes out of China. I think it really does come out of Russia. A lot of governments, including some here in the United States, some state governments, Texas, North Dakota, Alaska, have fiscal structures that are built on oil royalties, which are able to fund a lot of public infrastructure investment. But I think the causation coming out of China, I think this is the really important point Richard's making, is that if you have that as your causation, that I don't see that getting better anytime soon, because China can't get better very soon. China's going to try to muddle through, a deleveraging process that will take years, and that would keep interest rates down for a long time. Combined to that, the pressures within OPEC, where they've been unable to decide to reduce quotas to try to push prices back up. And countries like Russia and Venezuela and Iran are under tremendous pressure, and you could see something that to me feels more like a 1998 event than anything like 2008.
So now you had mentioned Russia within the mix of all this, Dr. Banaian, and I'm wondering if you could give me maybe an update on the state of the economy in Russia and Ukraine, and the potential for the problems in Russia right now and their ability to take on further debt and their potential rumored agreements with China. What do you think that that the scenario Russia's in now, as far as their public debt situation, how do you think this is going to play out over the longer run? Or is the state going to end up putting its own self into a bind?
Well, I think they've already put themselves in a bind. A series of events that started with the unexpected collapse of the previous government in Ukraine has given Russia and Putin at first what looked like an opportunity to bolster domestic political support through its invasion of Crimea and the Donbass region and in Ukraine, and that put some pressure, of course, on their budget, because running armies and shooting off munitions is expensive stuff. Add to that a generally weak economy, and you already had some tenuousness to where they were, and then understand that their budget is based on an oil price that's around $90 to $100 a barrel. Certainly don't expect prices to stay at 55, but I don't think they're going to go to 90 or 100 anytime soon either. And that puts a significant crimp into their budget. Now, add to that the fact that it seems over the last 4 to 6 months, the U.S. and the EU and NATO have sort of figured out that there's a longer game to play with Ukraine in terms of keeping the pressure on Russia. And keeping Russia having to engage and not pull back and regroup and try to reduce their exposure there. And I think the situation in Russia right now is somewhat volatile. I think it goes one of two ways. Either Putin has to sort of get rid of elections and declare himself a dictator of some sort, or you're going to see some kind of governmental change there sometime in the next 12 to 18 months.
Yeah, and let's keep this in perspective. Russia is a very small country. Their GDP is about $2.1 trillion. That's compared to the U.S.'s $17 trillion. That's compared to the world's $70 trillion. Russia is a small factor. Their economy is smaller than Spain. Their reputation is outsized. And to top it all off, they're a small country dependent on one commodity. That's oil. And oil's in the soup. So Russia's in the soup.
So, Richard, then if we're looking at the problems that are going to be coming out with Russia now, as I was asking you guys earlier, if there's going to be some sort of unknown event, oil seems to have caught everybody off guard, and then now it's bringing down Russia, and there's problems there. Actually, for both of you, if Richard, if you could answer first, I'd appreciate it. Is this going to be a scenario now where we're going to have to do QE for the world, or we're going to have all central banks involved? Could this be the unknown event that now the U.S. Fed specifically, is going to have to, use as their way to continue with low rates? Because everybody was expecting the Fed to raise rates, and now
I think the fact that there's overcapacity around the world, and as a result, very low private loan demand is what is going to keep interest rates low. So we're going to have downward pressure on commodity prices and low interest rates for quite some time. Not because of anything the Fed does or doesn't do, frankly, but just because of the overcapacity, the global overcapacity, which is at an historic high. The Feds kind of have this very simplistic toolkit, one of which is what they call QE, which is just buying government bonds. But the amounts that have been done are relatively trivial compared to the size of the world debt economy. In the U.S. alone, we have about $45 trillion worth of debt between the private sector and government. And the amount of QE, which is now down to about zero, it was at its peak, $80 billion a month, and it's now kind of officially ended. Those amounts are de minimis. The Fed and the ECB think they're doing very important work with QE. I don't think it's very meaningful in the grand scheme of things. The thing that will help, whether it's in China, the U.S., or Russia, is debt restructuring. But that tends to be something that folks really don't look at very carefully.
Okay, and Dr. Banaian, what do you think about the impact of global central banks needing to take action now that this perceived unknown problem of cheaper oil is now seen to be dragging down the Russian economy, the Russian currency, and then now it seems to be having trickle-on effects throughout the rest of emerging markets, throughout the rest of Europe. Do you see QE, quote unquote QE for the world working out in the long run?
Well, if there's going to be QE for the world, I don't think the U.S. is going to be the place that does it. I agreed with the last sentence Richard had, but before that, in saying that QE was kind of a drop in the bucket. Yeah, it was $80 billion, but it was $80 billion a month, and you actually ended up raising the size of excess reserves, which are largely being held in those bonds on the asset side of the Fed's balance sheet, from $2 trillion to $4.5 trillion. $2.5 trillion might not sound like a lot, but it's a fair amount. It's important to remember that 1998's events were started by countries like Indonesia and Thailand, which were relatively smaller economies than Russia is today. So the potential is there, and where we're seeing it most, I believe, is with the ECB and sort of this tension now that seems to be rebuilding between the ECB and Mario Draghi and pieces of the Merkel government in Germany, who seem completely unwilling to go beyond some really mild QE that really I'd agree with Richard on this. Whatever it is the ECB would do would be basically a pop gun in a nuclear holocaust. Would do nothing whatsoever to change the dynamics of what's bound to happen. But I do agree with him that what we really need is private debt restructuring. We've put it off for 6-7 years, and it looks like we're going to put it off a while longer.
We're on the line with Richard Vague, Managing Partner at Gabriel Investments, and Dr. King Banaian, former Minnesota State Representative. Gentlemen, we got just a few minutes left here before we wrap up the show. Let's just, we could talk about these things and, very complicated, Russia, crude oil, all the implications of the Fed, but what we like to do for our show is get across to the individual investor, the individual listener out there, the average guy that doesn't have time to focus on these things like you do or we do. What would be your outlook, your advice for the average investor in 2015? And we'll start with you, Mr. Vague.
Well, I'm not a stock picker. Most of our investing is in private firms. But, generally speaking, I think we're in a situation right now where, once again, the U.S. looks really good compared to the rest of the world. Whatever problems we have, and we have many, in comparison, the U.S. is in good shape. And since we are a net importer of oil, we're going to get a little bit of a boost from these lower commodity prices. Of course, there's going to be pockets like Texas and Louisiana and certain banks that are energy lenders that are going to get hurt. But on balance, we're going to be a little bit better off as a result of all this. So I think my main thought over the next 2 or 3 years is, stay domestic. Keep a wary eye on China. South America, which is, by the way, where I'm talking to you from, is, you have very export-oriented economies in Chile, Peru, and Brazil. They're all going to be hurt badly. Africa is going to be hurt. There's going to be a lot of Asia-Pacific countries like Australia who've really grown rapidly exporting to China. They're going to be hurt. So it's kind of one of those situations where, there might be a little bit of money to be made overseas here and there. But as a general matter, I think the United States is going to be the better place to be.
Dr. Banaian?
Yeah, and I think Richard's quite right. I was watching football last night, watching the national semifinal game, and one of the things that impressed me was that they ran a series of commercials in the fourth quarter for a Lincoln. Okay, I was thinking to myself, okay, 5 years ago, what was the likelihood we'd be running luxury car ads during a football game? I think it's a sign that the American consumer feels a little better off. That they feel like they've got a little extra money in their pocket, and I think oil prices have contributed to that. And so I think that the U.S. market's good. I don't think I'd pull back. I agree with. I heard some of your discussion with Ron and Son and Peter Schiff, and I agree that the market looks a little overpriced right now. But this market's done pretty well by the theory of being the least dirty shirt in the laundry, and I think it's going to probably continue in that vein for at least another year.
Okay, Richard Vague and Dr. King Banaian joining us here on Benzinga's Pre-Market Prep, brought to you by MarketFi. Gentlemen, sorry for the delay to getting you on, but we definitely appreciate your input and looking forward to the new year, having you guys on again.
Thank you.
Thank you.